Hi guys, welcome to my YouTube channel. My name is Nguna Esther, and in this YouTube channel I teach people to attain financial freedom. The channel is all about investing, all about personal finance, all about finance. Okay, and please, if you haven't subscribed, do subscribe, and also subscribe for more such content on finance and everything investing. So in today's video, it's a continuation on the first part of how to invest or where to invest, especially in Kenya. And in today's video, I'm going to be talking about shares. We're going to be continuing on shares. Okay, so without further ado, let's get straight into the video. In my other video, I had talked about shares, being a shareholder, where to find listed companies. So in today's video, I'm going to be telling you how to now own shares in whichever company that you want to own. Okay, and the first part is that you have to find a stockbroker or a brokerage house. And a stockbroker, it's a financial firm that connects you, the investor, to the stock market, because you as an investor, you can't go straight to the company that you want to buy, or you can't go straight to NSE and tell them, you know what, I want to buy this and this shares from maybe Safaricom as an example. So a stockbroker will connect you to the stock market. Okay, and how to identify a stockbroker, because there are many. The first thing is that you go to either CMA's website. CMA is Capital Markets Authority, or NSE's website, or even their apps, and you check the list of the stockbrokers that are listed there. That's the first part. So the reason why you do this is that you want to get an authorized stockbroker, one that is authorized and also regulated by CMA. CMA, they regulate any company that involves gathering capital or collecting money from people. CMA regulates such companies. So the first thing is you identify a regulated and also a licensed stockbroker. And the second thing is now to gauge the reputation of these stockbrokers. So the best way to gauge on the reputation of stockbrokers is go to their websites, the individual websites. Uko chini, you'll find feedback on how different investors find them. Yeah. So the best way, go online. Also ask people around, ask fellow investors on their experience with different stockbrokers, and you will find that some stockbrokers are preferred over others for different reasons. So you want to get the one that has the best reputation. The other factor to consider before settling for a stockbroker is the brokerage fees that they charge, or the commissions. Remember, this commission, despite the percentage, it always eats into your returns, especially in the long term. It will eat into your returns. So you want to find one with a very affordable brokerage fee, so that you maintain, at least you maintain the value of your returns. See, ati unapata do, you get capital gains and then 1% ama 2% ama whichever percentage, especially the high ones, all of it goes to your stockbroker. So you want to find one that charges very affordable stock brokerage fees. So the other factor is that you should ask your stockbroker if they have an agent that you can call in case of kwame mahali. And because this is very important, especially for when you're trying to purchase or sell shares, you should have someone to guide you, especially if you're a first-time investor. Even if you're not a first-time investor, you should always have an agent that you can call and who can sort you out immediately. Okay. The other factor to consider is actually your bank. Please inquire if your bank has a stock brokerage department. If they do, that is very convenient, even in terms of transferring the funds. So yeah, now that you have identified your stockbroker, the other thing now is to opening your CDS account. A CDS account is a central depository and settlement account. And who opens this CDS account for you? Your stockbroker. So your stockbroker will open a CDS account for you. It's supposed to be free, or at least as at now, it's free to open a CDS account. So a CDS account, it's like a bank account, but now for holding your shares and your other securities like derivatives and so on. So this is where your portfolio will be reflecting. If you buy Safaricom shares, inaonyesha hapa. If you buy equity shares, it shows here. Okay, so a CDS account, it's a bank account, but for your shares. Yes. So now you have your CDS account opened, you bought your shares, you've traded a couple of times, you have a portfolio. And what's a portfolio? A portfolio, it's a collection of your investments. Okay, it's a collection of all those shares that you've bought, all those bonds you bought, all those derivatives you bought, and then see they all reflect in your CDS account. So a portfolio should be well diversified in order to maximize returns and to minimize risk. And to minimize risk in this way. So for example, you buy, let's say like 5 banks, 5 agricultural companies, and then low season is here for agricultural companies. So they're not making as much profits. Of course, the share price will go down. Yeah. So you find that the value of your portfolio will go down if it's low season. So to minimize this, you should balance your portfolio and have different industries represented in your portfolio. So you should buy some banks here and there, some telcos here and there, an industrial company, an agricultural company, so that you have a well diversified portfolio. It's all round in the industry. Also, in terms of different asset classes, you should have equities. Equities are high risk, to mean that the return is high, but also the risk of losing is also high. You should also have an element of medium risk. So for me, I consider blue chip stocks as medium risk. The other thing, you should also have low risk investments, and these are your bonds, because bonds will always give you steady income. Unlike a share that will fall from, fall this month, rise, there's the volatility, but for a bond, it's steady income throughout. So you should also have a diversified portfolio so that you're not always having heart attacks kama utapata pesa this time round. At least when you have a steady income element in your portfolio, you're assured of some. So now you have your well diversified portfolio. So you want to understand why should you be investing in shares in the first place. And shares, first of all, they have unlimited returns in the form of capital gains, and this is how they work. I know of someone who bought Safaricom shares during their IPO, that's their initial public offer, at about 5 shillings, and now Safaricom shares have gone up. So you find that the margin of going up is very high, that the return is unlimited. They could always go up to whatever percentage, they could also go down to whatever percentage, and that's why they are high risk and also high return. Okay, so that's the first advantage, is that they have unlimited returns. Secondly, it's also very easy to go into the stock market and also to sell shares. When you get a stockbroker, you execute a purchase order. It takes the trading day plus 3 days maximum. Selling also the same. So the liquidity is very high. Yeah, it's easy to convert your money into cash. It's also easy to convert your cash. Sorry, it's easy to convert your cash into shares, and also easy to convert it back to money, that is selling. So it's easy to convert your cash into shares and also to convert your shares into cash, that is now get out of the stock market or sell your shares. So at this point, I would like to introduce 2 concepts which are very important, especially when a share price is falling. So shares, you find that they have unlimited returns, but the same way they are rising is also the same way they could fall. So I would like to take you through instances of where a share price is falling and what you could do in such a case. So the first thing you could do is actually averaging down. Okay, it's a concept called averaging down, and averaging down is buying more shares when the share price is falling. Okay, buying more shares of a company when its share price is falling. So what happens is that when a share price is falling, you need to ask yourself, why is it falling? Is it falling due to internal factors in the company or due to external factors that the company can't control? So let's say, for example, Safaricom. So you buy Safaricom shares at maybe 15 shillings, and then it keeps on falling. It keeps on dropping. So you need to ask yourself, why is their share price falling? And you could ask yourself questions such as, is their management okay? Are they experiencing poor management, fraud, corruption? Those are indicators of poor management. Are they retrenching? Are they shutting down business? Are they experiencing shrinking business? If not, then the company is pretty much okay. Especially now, you could actually find a company that is, that the share price is falling, but it's doing very well because of macroeconomic factors. let's say again Safaricom, you find that they have opened a branch in Ethiopia, they are not retrenching, they are actually posting profits. So the company is doing well, the management is also okay. So it's doing well. And now what is affecting the share price is macroeconomic factors, such as now investors, fleeing from, or capital flight from Safaricom to the US market because there are higher rates of return in the US. So you find that that is beyond Safaricom. So the company is doing well. So you could actually buy more shares of this company at this time so that you can be able to maximize your profit margins. For example, if you had bought at 15 and now maybe the share price is at 10 shillings, so you find that your average buying price is 15 plus 10 divided by 2, that's 12.5. So when the share price comes back to 15, you're already at a profit. From 12.5 to 15, you're at a profit. Unlike before, where you had to wait for the share price to go beyond 15, the 15 mark, for you to make a profit. So averaging down will reduce your average buying price, increasing the profit chances for you. The other concept when a company's share is falling is called having a stop loss. And just the same way you should have an objective before buying any share, is the same way you should also have an objective when that share price starts to fall. So a stop loss, it's the price at which you sell at when a company's share price is falling. Okay, so let's say a company is falling, it's fallen from 15, it's coming to 13 to 10. The amount of loss that you can stomach, useme, now we are done, let me sell these shares, that's your stop loss. And this helps you to stop incurring further losses. And these are very important. You should always gauge why a company's share is falling in the first place before selling or even holding, before you make your decision to sell or to hold or to buy more. So with those tips, you're empowered to get into the stock exchange. And as a general rule of thumb, never buy a company that you do not understand what they do on a daily, day to day. You should understand their business for you to be able to gauge whether it's a company that will grow or a company that actually suits your needs, if you're there for dividends or if you're there for capital gains. Secondly, each company always has seasons. Each share has seasons. There's the boom season, there's a depressed season. So just experiencing a paper loss does not mean that the company is doing badly, because each company share price iko hivi. There's a time it a boom, there's a time it enda chini. It will always come back if the company is doing well. If the fundamentals of the company are okay, it will always come back. The other tip is that when people are selling, you should actually buy. And then when people are buying, you should sell. And the last tip is that for dividends especially, get an undervalued company, get an undervalued share price. This means that you should check a superior company, or you should get a superior company that has shares that are trading at fair prices. It means that the stock is undervalued. Okay, and with those, we have come to the end of this video. Please subscribe. I hope you really learned a lot. If you have any questions, any comments, do put them down in the comment section. I've also linked the other part 1 of the video on this video, so also do watch it. And thank you so much for watching. Thank you so much for the support. I'll see you in my next video. Bye.